When most people think of investing, they picture stocks, ETFs, or maybe a dash of crypto. But there's a quieter, less accessible world moving billions behind the scenes. It's called private markets. And no, it's not just for billionaires anymore. This is where the wealthy play by different rules, and the rest of us are just now getting the invite. Let's unpack that a little bit more. In the world of private markets, things aren't always what they seem. Imagine investing in a company that doesn't even have a stock ticker. It's like dating someone who doesn't use social media. Mysterious? Yes. Risky? Also yes. But potentially rewarding? Absolutely. Private markets include things like private equity, venture capital, private credit, and private real estate. These aren't investments that you'll find scrolling through Robinhood or watching on CNBC. They're behind the scenes, slower moving, higher stakes deals, and they're finally becoming more accessible to regular investors. Welcome to the Smart Money Countdown, where personal finance meets punchy, fact-based breakdowns. Every Tuesday and Thursday, we give you the 15 things that you need to know about what's trending in money, investing, and building real wealth, while on Sundays, we make deep dive videos. Subscribe now if you want to make smarter money moves without spending hours reading through another finance book. Alright, let's break down private markets and 15 things that beginners need to know before diving in. Number 15. Private markets are off the public radar. The private markets refer to investments that aren't traded on public stock exchanges. That means no tickers, no flashy graphs, and no real-time price updates. Instead, you're dealing with private equity, venture capital, private real estate, and private credit. Essentially, the grown-up table of investing. These markets operate behind the scenes, often with less transparency but potentially higher rewards. They're where companies raise capital without going public, and where investors can access opportunities that aren't available on Robinhood or E-Trade. This lack of visibility can be intimidating, but it also means less volatility and more control over the investment process. For example, buying shares of VC-backed coffee company, private. Lending $10,000 to a developer building a boutique hotel, private. Putting capital into a private equity fund that buys distressed gyms, also private. If the public market is small, then the private market is an unlisted speakeasy. Fewer people know it exists, even fewer people get in. But the real action, it's in there. Remember, if you can Google the price, it's too mainstream for the private market crowd. Number 14. They used to be exclusive, but that's changing. Historically, private markets were the playground of institutional investors and ultra-high net worthy individuals. Think pension funds, endowments, and billionaires. But, thanks to fintech platforms and evolving regulations, the velvet rope is loosening. Because why should billionaires have all the fun losing money in unregulated markets? Today, some platforms are opening the doors to everyday investors. Sure, you still need to meet certain criteria in many cases, but the barriers are so much lower than they've ever been. This democratization is reshaping the investment landscape, allowing more and more people to diversify their portfolios with alternative assets. However, a word of caution. Lower barriers don't mean lower risks. Accessibility is a privilege, not an excuse to dive in blind. And number 13. No daily price tags, just estimates. Unlike public stocks, private investments don't have prices that update every second. Valuations are typically reported quarterly, and they're based on appraisals, internal models, or comparable sales, not market demand. If public stocks are a calculator, private calculations are a mood ring. It's like checking your house's value on Zillow. You get a ballpark figure, but it's not gospel. This can make it harder to track down performance in real time, but it also shields you from the emotional roller coaster of daily market swings. Investors must learn to be patient and focus on long-term value creation rather than short-term price movements. Some, they see this as a flaw. Others say it's freedom from the noise of daily market swings. Either way, expect ambiguity. Number 12. Liquidity is limited. Your money is locked up. Liquidity, what's that? In private markets, liquidity is a luxury. Once you invest, you often can't pull your money out for years. Some funds have lockup periods of 5, 7, even 10 years. So let's unpack that a little bit more. This isn't like selling a stock with a click. It's more like a financial marriage, without the party. You need to be comfortable tying up capital for the long haul and not needing it for emergencies or short-term goals. This liquidity premium is one reason why private investments can offer higher returns. You're being compensated for giving up access to your money. Smart tip. Never put short-term cash into long-term lockups. Only invest what you truly won't need. Think of it like Hotel California. You can check in anytime that you'd like, but your cash can never leave. Number 11. Access is still restricted, but not impossible. Many private investments are still limited to accredited investors, which means having a net worth of over $1 million, excluding your home, or an income over $200,000 per year. However, some platforms now offer access to non-accredited investors through vehicles like interval funds, REITs, or crowdfunding deals. These options do come with their own risks and limitations though, so always be sure to read the fine print. Not all access is created equal. It's important to understand the structure, the fees, and the exit options before committing your capital. Regulation A+, crowdfunding exemptions, and interval fund structures are making certain offerings available to non-accredited investors. And here's a reality check. Just because something is technically accessible doesn't mean it's a good idea for your portfolio. Number 10. Minimum investments vary and can be steep. Now, you might find private market opportunities with minimums as low as $500, but many require $25,000, $100,000, or even more. There's no buy now, pay later button here. You're in the big leagues. Private markets assume that you are showing up with real cash and a long attention span. This isn't for dabblers. It is for investors who are serious about building long-term wealth. The high minimums also serve as a filter, ensuring that only committed investors are able to participate. Small buy-ins often mean pooled investments, where you're along for the ride. Larger ones mean more control, better reporting, and sometimes even negotiation on terms. But here's a big red flag. If a platform asks you for $50,000 but can't explain where your money goes, just walk away. Think of private markets as the financial version of bottle service. You pay more to sit closer to the action. Number 9. Fees are higher, and they add up. Private market fees are notoriously steep. The standard model in private equity is 2 and 20, a 2% annual management fee plus 20% of any profits. That might not sound like very much, but over time it can significantly eat into your returns. Unlike index funds with rock bottom fees, private investments require you to pay for access, expertise, and exclusivity. Always factor in fees when evaluating potential returns. They can be the difference between a good investment and a mediocre one. Number 8. Due diligence is your responsibility. In public markets, companies are required to disclose a mountain of information. In private markets, not so much. Let's unpack that a little bit further. In the world of private markets, things are not always what they seem. You are responsible for vetting the fund manager, understanding the investment strategy, reading the terms, and knowing the exit plan. There's no hand-holding here. If you don't do your homework, you could end up in a very bad deal with no easy way out. So consider hiring a financial advisor or a consultant if you're unsure. The cost of advice is often far less than the cost of a bad investment. Be sure to ask your questions, read the full documents, and understand who's managing the fund, how do the returns work, how are distributions handled, and what happens in a downside scenario. If you don't understand it, just don't invest in it. Number 7. Returns can outperform, but the spread is wide. One of the biggest draws of private markets is the potential for outsized returns. Top-tier private equity and venture capital funds have historically outperformed the S&P 500 over long periods. So let's go ahead and unpack that. But averages can be misleading. The best funds, they soar, while the worst ones can lose you everything. Picking the right manager is only half the battle. And remember, past performance is no guarantee of future results. Diversification across managers, strategies, and asset classes can help mitigate risk. The private market is kind of like reality TV. It's dramatic, it's unpredictable, and it's pretty expensive to watch. And hey, if this video's been helpful so far, please be sure to hit that subscribe button. We break down trending money topics like this every week. Number 6. Private equity is about buying, fixing, and flipping companies. Private equity firms buy entire companies, improve operations, cut costs, and aim to sell them for a profit. It's like flipping houses, but with business. Sometimes it works brilliantly. Other times, you end up owning a piece of a dying brand and awkward silence at dinner parties. It is a high risk, it is a high reward, and it is not for the faint of heart. Understanding the firm's track record and investment thesis is crucial before investing. You are backing operators, not stock prices. It is risky. PE deals, they're pretty complex. Sure, you might fund the next Zoom info, but you could also be funding the next Blockbuster reboot. Pro tip: look for firms with clear thesis, strong track records, and constant returns across multiple cycles. Number 5. Private credit turns you into the bank. Private credit involves lending money directly to businesses, often those who can't or don't want to borrow from traditional banks. It is a booming space, especially as banks tighten lending standards. So returns can be much higher than traditional bonds, but so is the risk. If the borrower defaults, it's you who's on the hook. You are the bank now. And banks, they don't always win. Proper underwriting and diversification are key to managing risk in private credit. Number 4. Secondary markets offer some, but not much, liquidity. A growing number of platforms are creating secondary markets for private investments. This means that you might be able to sell your stake before the fund ends, but I wouldn't count on it. Liquidity, as we said before, is very limited. Pricing is often vague and you may have to sell at a discount. Sure, it is a nice option to have, but it's not a reliable exit strategy. Always plan to hold your investments to maturity and treat secondary sales as a backup plan. Trying to sell in a secondary market is like trying to return used shorts. Possible, yeah, but very awkward. Number 3. Taxes can get complicated. Private investments often come with K-1 forms instead of a nice clean 1099, which report your share of income, deductions, and credits. These can be complex and may require filling in multiple states. It's not tax chaos, but it's definitely not a simple W-2. So if you're not a fan of paperwork, then you'll want a CPA who knows their way around private investments and doesn't charge by the SI. Tax efficiency should be part of your investment strategy from day one. Number 2. These are long-term plays, not quick flips. Private markets are built for potential capital. You'll likely need to commit your money for 5 to 10 years, sometimes even longer. Private market investing is not for the let's see what happens in the next quarter crowd. It is a financial relationship more committed than most people's marriages. So if you're thinking short term, this isn't the right place for you. This isn't a weekend side hustle, it is a financially delayed gratification. But for those who can wait, the payoff can be so worth it. Long-term thinking is a competitive advantage in a world obsessed with instant results. Number 1. Private markets can diversify your portfolio, but only after the basics. Private investments can add diversification and potentially boost returns, but they're not a substitute for a solid foundation. Before diving in, make sure your public investments, like stocks, bonds, and cash reserves, are in very good shape. When the stock market throws a tantrum, your private stuff just shrugs and stays mysterious. Private markets, though, they aren't magic. They're not guaranteed, and they are not for everyone. But if you are ready, then they can be a very smart second step toward building real wealth. If you approach it like a professional, even as a beginner, you just might unlock something truly special. But what's stopping you from diving into private markets? Be honest, is it the fees, the risks, or just the fear of commitment? Drop your answers down in the comment section below, and let's see which one is the most common reason. And hey, want to go deeper in on this topic? Click on the next video on private equity investing for beginners. It's packed with smart, no-fluff money moves that you won't want to miss. And well, that wraps up today's video. If you found this helpful, be sure to hit that like button and subscribe for more smart money moves, and share this with someone who's still trying to hustle their way to financial freedom. They probably need to hear it.